investing. So anyways, these athletes have been sort of like Scrappy style out there in the social universe as their own people.
Morning.
Good morning.
Jennifer, I'm digging the sunflower. Good way to be.
Hello, everybody. Sorry, I was just finishing up a call there, and I know Jags is popping
Hey
in.
guys, I'm here.
Morning.
Hi, Jags.
Hi, how is it
Bye.
going?
Good.
That's
I
good. That's
think.
good. Let's get an update on Jennifer's daughter. Have they
Oh,
arrived? Where
they
need-
left, they went to Chicago and now they're in
Is that
Ann
me?
Arbor.
Oh, nice, nice.
Yeah,
Um,
revisiting their school days, I guess.
well, we'll wait a few more minutes, and in the meantime, happy to answer any questions. We're gonna join the pitch session today, right? Whoever can join. And then we have office hour tomorrow. So any question, this is going to be a little bit of heavy session today, as Kate mentioned last time. So if you have any questions, we can go over it tomorrow, but feel free to, interrupt as we go through this as well. Yeah, any news? By the way, we closed the heirloom round, oversubscribed from our part too. So that's great news. We are happy to do the syndicate for that. And we met with the founder yesterday, and we brought in a couple of people from the previous cohort, and it's really exciting. They can share a little bit more about the entire process as well, because now I'm just doing a lot of paperwork and making sure that the term sheets and everything is sent to all the people in the syndicate, and yeah, and we are actually really, really excited to see what the next step is, as they're waiting for a proposal from Amazon. I'll keep you guys updated.
Yeah.
Yeah, we ended up raising over 100,000. 100,000 was our goal. We ended up raising a little bit over 100,000. So that's really great. Anyways, yes. Shall
And
we
did you,
go ahead.
do you have a standard LLC for that, Jags, or?
So I did this with Zoe, who is from the previous cohort. So Zoe and I got together, and so she's based out of Canada. So we did an LLC because I was doing this with her. So we did an LLC out of Canada, and so we're investing as that LLC. Yeah, but usually I don't invest under an LLC. I just invest under my trust.
Yeah.
My trust name. And I know there's some people, like last time we had an individual in our cohort one, she comes from a lot of wealth. So she wanted to do it through LLC because it protects her. So I'm not at that level. So I just, I just do through my trust.
I'm smiling because I'm seeing Beth with her glass of wine and it's 11 where I am. And I'm like, well, wait.
I have my coffee. I'm starting the day.
I love it.
It's 5 o'clock somewhere, right?
Yeah.
I'm back somewhere.
It was a
Um,
long
great.
work.
Yeah. So shall we get started because we do have a heavy load. So if you guys are okay, Kate, shall we get started or do we need to wait?
Go ahead.
Okay.
Yep. Go ahead.
Okay, so again, I'm going to minimize my video area so I can't see you guys. So please speak up if you have any questions. Feel free to interrupt or put it in chat, and Kate will, also speak up to so we can address any questions in chat. So I'm running on a very, very low sleep today because my dog, he's really, really old. And I think he's having bladder problems. So I end up sleeping with him downstairs on the sofa, which is not, which is okay. But he just needed to go out every hour last night. So if I slur my words or whatever, it's not that I actually started drinking early, but I just didn't have enough sleep. So let me know if I don't make sense either. Okay, so let's get started. So session 4, week 2, last session of this week, and we're going to go deep into a little bit of financial terms and term sheets, and next week we'll all get into even more venture math, right? So whatever I present to you today, if there is something that like, okay, how do we do this, ask right away, or you could wait until the next week when we go deeper into it. So your choice. So today we are going to go over financial terms. When I say financial terms, I'm mainly speaking from the term sheet perspective. What kind of term sheets are there? What kind of things that you should be looking out when you do get a convertible note or safe or priced round term sheet, and then what are some of the things that you can negotiate. And then the financial statements also, I'm going to go through that. And these are the financial statements that obviously depends on what stage the company is, but if it's a company that is a post MVP, maybe post revenue, definitely make sure that you guys ask for this. And it's okay if they say we don't have that yet, but I just want to make sure that if the founders don't even know what that is, it's something, not a red flag necessarily, because a lot of founders don't have the financial know-how yet, but are they, do they even know that they need to have this or get an advice from somebody to have this? Just give me a second. I'm going to turn my heater on. My back is really cold. Hold on one second. So let's dive into it. So term sheet makeup, right? So we talked a little bit about what convertible note is, what safe term is, and what what equity terms are. And these are some of the highlights under each one of them. So convertible debt term is like a loan. It has a cap, or it cannot have a cap, right? So I always say cap because I got burnt once. It has interest rate, it has discount, and it has maturity. It has to have the interest rate and the maturity date because it's a loan instrument. Discount and cap are optional. Safe note is, it came from Y Combinator. It's the cheapest way for founders to raise money through Safe Note. They don't have interest rate. It's simple, and it doesn't even have maturity date. Doesn't have to have discount. Doesn't have to have cap. And the equity is actually the stock. So most of the startups get converted into equity, preferred equity at Series A. So if you're an early stage investor, you're most of the time you're investing in as a safe or convertible note. Very rarely you see founders spending the money to actually create a equity instrument. And then there are common versus preferred. So common stocks are like employee stocks, founder stocks, and preferred are investor stocks. And even in those, there are different levels. The liquidation preference, who has the governance. So if a VC comes in and puts a lot of money, they want a board seat, they want voting rights, et cetera, et cetera. So all that comes in play in equity terms. And then the first thing is the capital structure, right? Seniority versus return. So always the senior debt is the first to get paid. So debt is like a loan, right? So if they end up taking a loan, so loan always gets paid first, right? And then the senior debt. So if you have a seniority over the previous investors, you also get get paid with the preferred round in that pool of stock. So when you say seniority versus return, usually the first to get paid in an event of exit is going to have the lowest return. And the last to get paid, which is angel investors and other investors in the preferred pool, have a less seniority, but the highest rate of return because they have invested in this much earlier, right? So that's what I mean. I obviously always consult legal professionals to get advice. The information here is only from our experience. Any questions here? And we'll go through all this in much more detail.
Jags,
Yeah.
and you don't have to hit this yet. Maybe you'll hit it later. But Christina is wondering, anyone familiar with a case? So continuous equity agreements.
I am not.
Okay.
Yeah. I put it in the chat. It's not something we need to cover today. I'd love to get the group's thoughts on it sort of over the next few weeks or the next 2 weeks.
Great.
Yeah. Have you experienced that or have you invested in Hong Kong with that? Is that?
No, I have not. It's new to my understanding. And the only reason I know it popped up is a friend of mine started working for a company called Fairmint. And they, have obviously started to approach founders about a way to, an additional way to raise money without dilution that is also open to the broader public, it sounds like, on a continuous basis. So again, not something to cover today, but I just wanted to, if it starts to pop up, to see if it has legs and see what the group thinks.
And how do you spell that? I can't see that. Sorry.
Fairmint, Fair.
Oh, CASE, like case.
No, FE, Frank Edward.
Oh, like cafe.
Yes, cafe. Yeah, they call it a cafe.
Yeah.
Okay,
I
perfect.
just put the link in the chat.
Okay, I'll take a look at the link before we go. I can't see the chat yet, so
yeah, I hear you. Today's a heavy day, so it probably doesn't make sense to go through today, but over the coming weeks, maybe we could get thoughts on it.
And I really want to make sure that even though today is a heavy day, you should leave our cohort feeling that you understand at least everything that was covered, and then you can dig deeper into it. So even if it takes a little bit longer, if you do have to do an extra session, I'm open to it. I know Kate and I really want to have you guys feel really good about going out and start making investment, or at least explore. So whatever it takes, that's what we are here for. So even though it's heavy, just remember that in the back of your mind that I'm happy to do, an extra session to cover anything else that is, not clear. All right, having said that, let's move on. So there are two ways that usually, invest, the fundraising round is set, right? So in the early stage, in the angel round, sometimes there is a lead and sometimes there is not. And then there is a party round. So the heirloom term sheet was a party round. There were no lead investors saying that these are the terms that I want. Here, Miss Entrepreneur, if you're okay with it, I'll go ahead and invest and I'll help you raise the money. And usually when you're leading, you're also negotiating the terms with founders. You probably have a board seat possibility, and you are the first person to put 10 to 40% of the round that is being raised. It conducts and prepares the due diligence documents with the help of founders. So the founder is not necessarily, doing this over and over again with every investor they meet, and they share deals with other, and they literally sometimes go to their network and say, this is what I have, who wants in, and they're, if the entrepreneur and the company is really strong, the round is over before it even goes to the broader circle of influence. So that the party round is when there is no negotiation and founder says, this is what I want, and here it is, in or out, up to you. Obviously, if you have a really hot startup or a very reputable founder, they get to do the party round. And non-lead is, obviously no right to negotiate. So if I am not a lead investor, I have to rely on whoever set the term sheet. There is no negotiation for that. May or may not depend on the value they bring. Could be just a simple money, right? Also known as dumb money versus smart money. I don't like to use the word dumb because the money that every investor puts in is the hard-earned money. No matter what your wealth level is, it could go to your family, friends, whatever, but you're choosing to put the money. So, and that's, it's not, in my opinion, even though it's called dumb money, it's simple money, I like to call it. And they don't always do due diligence. Sometimes they do it, but they also rely on the due diligence from the lead. Also, they feel free to do the due diligence on their own as well. And they can also share deal with others, but they don't get any preferential terms because they're sharing the deal with others. So the capital structure, we talked about this. So now we are going to go through each one of those 4 items that I presented in the first slide, right? So seniority and return. The first to be paid is a senior debt, low risk, low return, right? It's a loan instrument, subordinate debt. So the second, so just think of it as a house, right? When you go out and you get a loan on the house. So you have a first mortgage and a second mortgage. So first mortgage always gets paid when you sell the house first, even before you get paid. So if you buy a house for 500,000, you end up, you have a loan of 300,000 and you sell the house for 350. 300,000 goes to the first mortgage and the 50,000, what's remaining is what you get, right? Subordinate debt is the second mortgage if you end up having a second mortgage. Preferred equity is more than most of the investors are, right? The angels and everybody. So they invested early. So their seniority level is lower. However, because they invested early, their return can be really high. So for example, Bay Area house market, right? I'm going to go back to house because it's really easy to understand. If I bought a house for $50,000 in 1975 and now it's $3 million, and I have over a period of time I have a loan on it or whatever of 500,000. Obviously, when I sell the house for $3 million, 500,000 gets paid. They don't get anything extra, but I get paid a lot of money because I happen to invest much early and held on to it or ride the market, etc. So I hope that is an easier way to understand this. And the common equity is the founder's equity, right? So even like in a house situation, preferred equity is somebody like, okay, I bought this house, with somebody else, he was completely an investor. I would pay them first and give them whatever I agreed to as a return, and then whatever is left comes to me. So the common equity is usually the employees, the founders. However, some VCs, they do prefer to have the common equity rights, but preferred equity status because they get paid first, but they have rights to vote, rights to hire, fire CEOs, etc., governance, things like that. So, but that's actually much later, and I don't know much about how that after Series B, comes in play from the VC perspective. So convertible note.
I'm sorry, Jags, what would an example of the senior debt and subordinate debt be then? Like literally a loan to a
Yeah,
bank?
yeah. So based on the loan date that it was taken. So the older debt gets paid first. So let's say that I took a loan out from my
Before
bank.
you got your round done.
Yeah.
Okay. Okay. That's fine. I got it.
Yeah.
Thanks.
And sorry, one question on that too before we move on. Is that common amongst angel investors to do loans? Because I'm
No.
hearing more now that like venture debt is becoming more common, but is it at the angel level also
Well,
becoming a bigger thing?
I have not done any, but I know of people who've done some. So what they do is, they say we don't want equity. We just want our, what we are what we are loaning you times 10% interest, right? So that's a loan. But that
Well,
is,
what would be the advantage to doing the loan versus getting the equity? Is it to get your money back
yeah,
sooner, or does that implement, or does that
No.
mean that there's a level of doubt on the future success if you choose to go that route?
also, what your portfolio makeup is, right? If you're not a very high risk tolerant person, but you want to be part of innovation economy. So for example, I'll give you an example of, have you guys heard of Amazon loans? So there are companies like Kick Further is one of the companies, or Pierce Capital. What they do is they get qualified by Amazon, and they go to Amazon and say, tell us the sellers who are doing really good. And Amazon gives them all the data, right? All the data. So these are the sellers who are looking for loan. These are, this is their business, right? Everything about how much they sell, what inventory they have, what's their margin, you get it from Amazon. And then they reach out to the startups or the sellers. I look at every business as a startup, whether it's a lifestyle business or venture-backed business. They go to them and say, I'll give you the money you need to grow your business, but I need 12% interest. So and then they work with Amazon to really hold on to their inventory. It's literally like sharks, right? But some angels are not exactly doing that, but they feel safer and it fits into their portfolio, that it's not really, really high risk, but it's not extremely low risk as putting the money in bank either. It's somewhere in between.
Okay, thanks.
And also it's an advantage of founders because they are not diluting their capital. Their equity, right? So convertible note. So let's go to the makeup of a convertible debt or note that usually is the most common version of the instrument that is used to invest in a startup. So we talked about a valuation cap, right? So valuation cap is the max pre-money valuation the note will get converted to in the next equity round, where the new investor will invest at a higher valuation. So the example is 5 million. So what that means is that I am investing in a startup and I'm signing a note, and the note says you have a cap of, when we get converted. So there are two ways that the note will get converted. When they're raising at a next round, so they will get converted into the preferred equity, or the business folds and it's just the convertible note is not good. So those are the two ways that I know of. And obviously there is an extension that if the entrepreneur needs some more time in order to raise the money it needs to get converted, there is an extension. And obviously the interest and everything gets calculated even for the extension. So the valuation cap is 5 million. So even if they raise a $10 million in Series A, I will get converted at $5 million plus whatever discount I have plus if I have an interest, whatever interest that I earn, that gets converted into the shares at that valuation. So the discount rate we talked about, that it is a 20% discount per share value relative to the new investor in the current round, right? So that's the discount. The interest is the cumulative interest that you get, not in a check format, but in a shares format, that whatever is on the convertible note. The maturity date, right? It has to have a maturity date. When does it expire? And usually, I have known startups that are still raising on the older convertible note. So let's say that as an entrepreneur, I have this convertible note and it expires in December of 2022. But in January of 2022, like, okay, I need a little bit more money. You could do two things, right? You could either have another convertible note if you have made a lot of progress and said, this is the note I am raising it, or if you have not made that much progress, and if you're still at a similar point where you were when you were raising the last round, you just use the same convertible note, but the expiration maturity date is still December 22nd.
Jax, are you going to show an example of how the math works?
Yes, yeah.
Okay.
Yeah, and if not, please remind me if I don't get exactly the math you're talking about. But a next session is all about venture math.
Okay.
Okay.
Thank you.
Qualified interest. The minimum amount of capital the next round has to be qualified, the note to be converted into equity pre-money. So if what this means is that there is a minimum amount of capital that needs to be raised in order for my note to get converted into the pre-money conversion of note into equity. Usually it's 20%. And the things below it, it is just in case there is an optional conversion at any point prior to maturity, note can get converted. So it doesn't have to wait until the maturity date, but the valuation cap, discount, and interest remains the same. It could also, if the company completes the qualified financing prior to maturity date, it also gets converted automatically. And also post-maturity, if no qualified financing. So when I say qualified financing, what it usually means is the next round of financing. So if you're in seed stage, the next round of qualified financing is Series A. Note holder can convert at a new valuation or have an option to convert at a predetermined valuation. These are some of the options that are in a convertible note. I have only what has happened to me is only the first one. So there is no, it's planned. So convertible note is expires in December of 2022. I expect the founder to start raising at least 6 to 9 months before that. But let's say that they haven't even started raising yet, and some investor comes and says, okay, I'm ready to invest whatever you need, and here is the check. So that means it automatically gets converted at that point, if there is a qualified financing event that happens. All right, SAFE. As we talked about, SAFE is a simple agreement for future equity, which was created by Y Combinator for mainly to use with their cohorts and the companies that are, to raise money and make it simple for their investors, because a lot of make it simple for them and for the startups, because a lot of the investors, were negotiating different terms, and these, whoever invested in Y Combinator companies, at least before, were really select few. So to eliminate all that back and forth, this is my understanding, and this is what I was told, that they created a SAFE agreement that is like, okay, if you want in, this is the agreement. Otherwise, as they got popular, people are like, okay, I'll sign anything, right? Because you have a track record of, you have an amazing track record. So in SAFE also, you can have a valuation cap or you don't have a valuation cap. Same definition as a convertible note. Discount rate, you can have a discount rate or you don't have a discount rate. There is no interest. and there is no maturity date. So that also alleviates some pressure of founders. If they're in the middle of, really, deep scientific research or product development, and they don't have time 6 to 9 months prior to the convertible note expiring, do the fundraising, or if they're not ready for it, it kind of alleviates some pressure of the founders. The minimum amount of capital the next round has to be qualified, the SAFE to be converted into the equity post money. So it says that in order for this SAFE to get converted into the into the preferred equity, you have to raise 20% of the valuation at that point. So that's what it means, and that would be the event that converts SAFE into the price round. They're very similar. It's just for founders, it's cheaper to set it up, and it also has some benefits for the founder as far as the maturity date. I'm going to keep going unless I have a question. Please feel free to interrupt. So the priced equity round, that's when we as angel investors get converted from convertible note in or SAFE into shares with price, etc. So the valuation is the value of the company. Preferred equity is what I will go through the liquidation preference, but here just remember that you would like to get a 1x liquidation preference prior to common equity holders. So what that means is that in an event of an exit, right? In an event of a company getting acquired or whatever the event is, that I want to get the preferred equity shareholders will get paid 1x of their original amount plus the percentage of the growth, depending on the percentage of the company that I have. Did everybody get that? So for example, if I'll give you an example, I invested $25,000 in company A, and in series C, so at that point, 25,000 was 1% of the company. Let's say that the valuation cap was $2.5 million, and 25% represented 1%, right? So when the company grew 10x, so now the valuation is 25 million, and I did not invest any more into the round. I only invested once. So in the event that the liquidation or the event of either merger, acquisition, whatever the event occurs, I want to get paid at least $25,000. So that's 1x my original, plus my $25,000 now has grown into $250,000, right? So the percentage, whatever percentage that I own at that point, I want that much in addition to the 25%, $25,000 of initial investment as my return. So for $25 million is 0.01%, right? $25,000. If that grew 50x, I want to make sure that I also get the amount, the growth amount that is owed to me for the return, in addition to the 1x. A lot of times, if it's a hard company, they give you no liquidation preference. We'll go through the liquidation preference in future slides. I have that, in an easy to understand format. Pro rata. So you could either have no pro rata, or you can have a pro rata to maintain. So in the example that I gave you, at $25,000 initially was 1% of the company. So the next round is at $10 million. So in order for me to maintain my 1% equity, I will have to invest that much more in the next round to maintain my 1% equity, if I have the pro rata right. Or you could be like, okay, you want to have 10% of the company, 9%, 5%. So you could also have as much as you want. So these are the three, parameters that are also, in the priced equity round that are defined. Governance right. board, you have information rights, et cetera, et cetera. So the most of the time, the founders have and also making sure the founder vesting is a 4-year cliff. So at that point, the whatever vesting or whatever, not the common shares, but a founder is also an employee. So they also get percentage of the employee stock option pool. So they, just because they are founder doesn't mean they get vested right away, right? They have a 4-year cliff. So that means 1 year, 1 year cliff. That means at the end, every year they get 25% of their options gets vested, just like every other employee pool, not including their common shares. And the employee option pool is created at this stage in Series A, and it is 10 to 25% of the either pre or post money. So what does that mean? So pre-money means that everybody who came in this round, angel investors, founder, everybody get diluted by 10% if the employee option pool is 10%. That is not in the best interest of the investors. It is in the best interest of, the previous investor. It is in the best interest of the investors that are coming in the next round. So most of the time, negotiate that we will create an employee option pool post money. It means at the end of raising this Series A round, everybody gets diluted by 10%. But the new investors don't want that. They're like, we just came in. We don't want to get diluted right away. So that is also something that you should pay attention to. Questions? Should we take a breath? Okay. So the equity terms, right? So these are some of the equity terms that you should get yourself familiar with. Common equity indicates the percentage ownership of the company. It has right to company assets, last to get paid. We talked about the seniority. Total common shares can always increase or decrease. Shares are issued to employees, board, advisors, and obviously founders from this bucket, right? So, and the reason they are getting paid from this bucket is because the investors do not want to get diluted if you decide to get an advisor and pay them 5%. It's like, okay, you want this advisor, you take it out of the common equity. That means, founders and employee stock options, everybody, we don't get that, we don't want to get diluted. Preferred equity, liquidation preference, right? We talked about that. So 1x prior to common equity holders, pro rata information inspection rights. Convertible preferred equity, it converts to preferred stock. So this is where the VCs really want to play with this, because they want some of their preferred stock converted to common stock, so they can have more control of the company as far as the voting rights, higher claim on assets. So for example, and I'm just using this as an example, I don't know the details of it. WeWork, if WeWork was doing so good and SoftBank invested so much money into them and then they collapsed, right? So if WeWork actually owned all the real estate they had, that the common equity, have more rights to the real estate. I believe they were renting anyways, but if they owned it, they would have rights to some of those assets as a form of liquidation. And then, it can, they can also have voting rights, information rights. And this is where the trick comes in, right? That, what do you call the insider trading? Obviously, when the company is private, it doesn't matter. But if the company becomes public, then having these rights also mean that you have some restrictions. Participating preferred equity gets paid dividend prior to common stock. I've never dealt with this. I don't know much about this. But this is where, like Series C, B, C, D, this is where they, really negotiate. So it's good to know these terms. Convertible participating preferred equity. So again, most VCs do this because they want to make sure that some of the preferred equity gets converted into the common equity, so they have the rights that the founders have. And now we're going through the valuation ownership analysis, right? And we'll go through each one of these areas. Pre-money versus post-money. What is that? Liquidation preference. We mentioned a little bit about that, but we'll go more into detail. Dilution. How do you dilute from one round to the other round? And we'll have an example of that. Participate or no participation at pro rata. Share price calculation. How do you do that? Multiple investment round analysis. So if you invested in pre-seed, and you owned 10% of the company, how does your 10% get diluted? We have a table for that. I see 11 things in the chat. Do I need to pay attention to that? Oh, okay. Maybe you want to change.
Nope, it's only one.
Okay, perfect. Okay.
You're good.
Okay, so the valuation, right? This is a very sticky area, especially when you're investing at a pre-seed or seed or early stage, pre-series A. So, what I would suggest in the valuation is that you want to invest when it's not too high and not too low. So what does that mean? So not too high means that last time I shared what is my sweet spot. So my sweet spot is between $3 and $6 million, right? But in Heirloom, it was $8 million. So did I invest? Yes, I invested. So I have a guideline, but it's, anything above, I, really take a look at the company, is the company worth it? Anything low, there is another Canadian company, Sumari. I invested in them, and they're such amazing customer success software, SaaS business model. And they were raising at $2.5 million. I know that they had customers, they had revenue, but I'm like, $2.5 million, I'm going to invest because I know this space. I believe in this, the founder. So I did my due diligence and I did that. So those are the two examples of I went outside of my, comfort zone, both because it made sense. But if an example that I gave last time with a female founder who came to me and said that they can, the minute it hits the platform, I can't share anything with you, but the minute it hits, we're going to have $1 million revenue, and we are now raising at $10 or $15 million valuation. I just couldn't get my head wrapped around it. No matter how much I liked her, no matter how much I believe in female founders, I'm not going to touch that deal, because I don't know anything about it and it's just too high. And also too low is also a concern. It's like, okay, this is too low. Unless I understand the reasons behind it, I'm not going to touch that either, because it could mean that they're just raising. It's to me, that indicates that they're not taking this business seriously. If they have a product that is really good, and they are making, they have revenue or they have customers lined up, they should definitely look at the valuation according to that. So too low to me means that this is still in a trial period. Even though it's an early stage, I like to see some level of seriousness. Second is that too much capital raise is not always a good thing either. So like I also give an example that if you're 4 founders or 3 founders and you are raising 30 or 40% of equity in your pre-series A, that's a big red flag, because that does not give room for the following investors to come in at a healthy percentage. So every round you assume that you're raising 20%. And if you give up a 30 or 40% in the beginning, and if you're 2 or 3 founders, which most companies do, you're going to get diluted. By the time you hit Series B, you're going to get diluted so much. You're like, why the hell am I spending 18 hours a day to just literally make money for my investors who came in early? So really have to pay attention to, how much are they raising and what are they going to use it for? Terms, current round terms are usually based on the results from the previous round, right? So what that means is that if they raised previously at a $5 million cap, and currently they're raising at $10 million cap, and that is 20% of the $10 million, which is, they're raising $1 million. How have they grown from $5 million to $10 million? So I always look at the terms from the previous round and say, let me see the terms from the previous round, and then understand the details, and then ask the questions based on that for the following round. Like, why are you, if you're raising at a $10 million, which, 18 months, that's pretty reasonable. But if you're raising at a $50 million valuation, what have you done from a previous term of $5 million to now $50 million? What justifies your growth within, 10x growth within 18 to 24 months? And that's how much time usually is between the fundraising, between each round. So liquidation preference, we talked about the liquidation preference, right? The no liquidation preference is either you get equal, meaning whatever you put in, and that's it. You either lose it all, or when it comes to gain, you could also make a lot of money, because it's only based on your percentage that you own at the time of liquidation. So if I own 1% of the company and the company sold for $25 million, I will get $2.5 million, or $250,000, 1%. And I don't get anything. It doesn't matter how much money I put in. I may have put in $250,000 before, but if the company does not sell for the valuation above what I invested in, I'll get whatever the percentage I own. And 1x and fully participating meaning is that I get 1x, meaning 1 times my initial investment. If it, in terms of, it's the same as when I invested at 1x plus the, whatever percentage that it grew. Loss is I still get at least 1x, 1x of the money I invested, and gain is 1x plus percentage of the company that I own from the remaining. So if it's a $25 million company sold for $25 million, I invested $250,000. So I get $250,000 plus 1% of 25 million minus 250,000, and whatever that is, 1% of that. And 2x is same. Hold on 1 second. I have an article here that explains, fully participating versus. I myself get confused between that. So so I think the fully participating meaning that. Let me come back to you on that, because I'm also confused today about that. I think it's a lack of sleep. So let me hold on 1 second. Because I only, as an angel investor, you always want to get just 1x liquidation, fully participating. That's what I strive for, and I negotiate. I never get 2x, or I never get 1x participation capped at 2x. As an initial investment, I either get no liquidation preference, or I get 1x liquidation plus fully participating. So if you have a company that is really hot, and they do the terms, you probably will get no liquidation preference. And let me come back to you on the fully participating and non-participating. Liquidation preference is obviously a downside protection. It only gets invoked when the company is not doing so well. So at least you want to get your money out. But I like to at least, get the 1x liquidation fully participating. All right. So post-money valuation, right? So if the pre-money valuation of the company was 5 million, and the investment in this round is 1 million, so the post-money is equal to 6 million. So if, as an investor, what is my ownership, right? So investment, if I made an investment of $1 million, in this round, I own 16.67% of the company because it's 1 million divided by 6 million. It's not 1 million divided by 5 million. So in order to calculate your ownership, you always want to say, what is the investment that you made in this round divided by what is the valuation after the money was raised. That's one way. And the other one is share price, right? So share price is pre-money divided by total number of outstanding shares. So in this case, it's dollar because it's a $5 million they're raising, and they have 5 million shares. So the per share price is $1. With the investment of 1 million, we have a total of 6 million shares. At a price of 1, the total in ownership of new investment round is 16.67%. So these are the two ways you can calculate your percentage of equity. Dilution. So all equity holder, investors, founders, employees, advisors, board, whoever owns a share are diluted after each capital raise. So if company raises $1 million, as we in the previous example, and gives away 16.67% of equity to new investor, all previous equity holders are also diluted by 16.67%. So so if you own 10% of the company before this round, now you own 8.33% of the company. So 10% got diluted by 16.67%, which means that you now own your 10% of the company now is equal to 8.33% of the company without putting any more money. So at this point, if you have a pro rata right, you want to say that I still want to have 10% of the company. So I will invest and make up the difference and still own 10% of the company. So here is a chart or the Excel spreadsheet, pre versus post-money valuation and valuation for all. So like, let's say the seed round, right? So the pre-money valuation at the seed round is 4 million. The seed investment is 1 million. The post-money valuation is 5 million. So in the seed round, the investors who came in the seed round, they own 20% of the company, which is 1 million divided by 5 million. So that's 20% of the company. And the rest is owned by the founder and the other, advisors, board, whoever in the 80%, right? And before seed round, founders owned 100% of the company. So they got diluted by, 20%. The next round, Series A, pre-money valuation is 8 million. Series A investment, new investment that came in is 2 million. So after you add the new investment, the post-money valuation is 10 million. So now Series A investor ownership, since they are the newest investor, they own 20% of the company, right? And because it's 2 divided by 10, right? And then the seed investor ownership, they get diluted, their 20% by the new equation. So they get diluted by from 20 to 16%. And then the founder and co-founders, the common shares, they get diluted by, and their equity goes from 80% to 64%. So the quick way to do this is that Series A investor ownership is 20%, right? So what is 20% of 20% of 20% is like 4. So I usually deduct 4 from the seed investor, which is 16, and the same thing from the 4 times 4, which is 16, and I deduct that from the 80% of founder, that brings me to 64%. I know it's a lot. Any questions? And it keeps going. Series B, That's the pre-money valuation is 16,000. The new money, sorry, this should say Series B investment. The new money comes in is 4 million. So the post-money valuation is 20 million. So 4 divided by 20 is still 20%. So the new investor own the 20% of the company. All the other previous investors, they get diluted by 20%. So Series A from yellow to blue, it goes from 20 to 16. Seed investor, they go from 16 to 13, and the founders go from 64 to 51. And we are not even looking at the employee stock options because that's all part of this, keeping it simple. Any questions here? Gotta have questions here. No.
Well, I assume there are cases where the seed investor doesn't want to get diluted that much. But they can't, there's nothing they can do about it?
No, so then if you have a pro rata right, you can say that, hey, I don't want to get diluted. I still want to hold my 20%, and I will put 4% of the raise. So in that
They would add in their own investment, additional investment to match, to keep their percentage.
yeah.
And does that go?
Yeah, you have to keep on buying that. That's what, when you hear the term follow-on investment,
Yeah.
that's often what a follow-on investment is doing, is like kicking back in to keep that owner.
Right. So, and sorry, and that only happens if you have pro rata rights. If you don't have pro rata rights, there's nothing you can do. You just have to get diluted.
Right.
But at the same time, this is the case. I have a smaller, I'm a smaller fish in a bigger pond because company is doing great. So as far as the percentage goes, yeah, I have a less percentage, but as far as the
It's a bigger company. I get that.
Yeah, and I have a 16% of a $10 million company versus 20% of $5 million company.
Mhm. I understand that. I understand. So, but let's say you did have that pro rata. So in the Series A, would your money be part of the $2 million, or would it, how
Yeah.
would that just, they would,
Well,
so the new round of people would have to let you buy into their round?
yeah. Well, if you have a pro rata right, there is nothing you can do. I mean, there is nothing they can do. You have a choice. Only if you say no, first right of refusal, then they can ask others. But it is part of this 20%.
Okay, thank you.
Yeah. There you go, pro rata. Pro rata and investment amount in the following round to maintain current percent of ownership. So a lot of times, you know, like for example, 500 startups, right? They always have pro rata right, whether they decide to invest or not. Because their philosophy is if the company is doing really good, we want to chase our winners. And, you know, if the company is not doing good, we can deny that first right of refusal. So pro rata doesn't mean that you have to invest it. It's just that you have a right, you know, first right of refusal. That's how I look at it. That if I want to, great. If I don't want to, I don't have to. So if you invest above pro rata, obviously it increases the percentage ownership. And if you invest below pro rata, then it decreases the percentage ownership. So again, if you have pro rata, you can either invest exactly to maintain that percentage, or you can go a little bit above if you can do that, or you can go a little bit below. You can say that, you know, I don't have $400,000 to keep my percentage. I have 200,000. So I invest 200,000, and, you know, from, you know, whatever that looks like, that's how much my ownership will get increased. Any questions before we go jump in the financial statements? And Kate, what time are we stopping today? Because we have, are we going all the way to 11, or are we?
Oh, we can do what you'd like to do. Our pitch session starts at 2 p.m. Eastern, or 11.
Okay.
If you want to give people a break, if you want to leave, I'm going to leave this flexibly up to you.
Sure.
This
that's-
is a dense topic, and so it is probably good to have a little break, but
Yeah, so let's
I'll leave
do
it up to
this.
you.
Let's stop at 10:45, which is 1:45 Eastern. We have 15-minute break to go get water, whatever you need to do, because the pitch competition, you want to make sure that you don't, it keeps one after the other. Okay, do you want to take a minute to explain what to expect in the pitch competition for those of us who are, maybe attending it for the
Oh,
first?
sure. Yeah, it's very straightforward. We popped these up post-COVID, mainly to give the founders in our audience who had essentially lost all of their fundraising opportunities, which are traditionally done in person. We wanted to give them an opportunity to still connect with investors. We have a pretty big investor network. And so we popped them up. It's very straightforward. The main goal is to get them introductions, our founders introductions to interested investors. And so they pitch for 5 minutes. There's maybe like 3 minutes of Q&A after that. And that's it. So they go in sequence, and then we close it out, and people can make intros and connections.
Got it. And there is no like judging or anything, not judging, but people asking.
No, this one is not this is not there is a little bit of a Q&A section. We try to keep it so that it's not necessarily hardball. But
Okay.
yeah, we dig into things like maybe go-to-market strategy or that type of thing. So yes, there is a Q&A section at the end of each pitch,
Okay.
but it's
Perfect.
not a competition.
Okay. And I think the goal for today to attend the pitch sessions is just to get an idea of, who, how, what companies are pitching right now. And I know Kate also has different industry or sector every week. So, maybe we are looking at, health, right? Digital health.
This week is digital health. I think we're doing fintech next week, except we had 2 folks who couldn't make it. So if anybody knows any fintech companies that need to pitch, let me know.
Okay. So I would recommend that, you go to a few of them if time permits on your schedule. All right. So before we jump into the next thing, any questions, anything that's confusing? Okay. Okay, so now we are actually pivoting a little bit from an investor perspective, term sheets, et cetera, to the financial statements that a founder should provide for, or you should ask or curious about if they're very, very early, right? So I always ask for these 3 financial statements, and I'll go through the reasons, why. And a lot of times, because they're early stage or, they haven't even thought about that, they're like, oh, we don't have them yet. But what are they, right? I get that question a lot as well. Like, am I missing something as a founder? Yeah, you are. You really need to, get a grip on understanding anything financially related for your business, because as a CEO, whether you have that expertise or not, you should know what they are and, able to walk up a prospective investor through those statements. And if you're way too early, it's okay. You don't have to have them, but at least you should know how you need to make sure that these statements play a huge part in all investor decisions as they go through different fundraising cycles, especially at family and friends round. It's not necessarily, right, because they're still at that stage. That's why it's called family and friends round. But if an investor, if I'm putting money in somebody, I want to know what is that, are they thinking about, cash flow or, forecast, et cetera, et cetera. So let's go through these 3 financial statements. So income statement. So I ask them for the income statement, and it on a month for a every month to month, right? So the income statement here, these are the things that I would like to see. What is the gross revenue? What is that net revenue, right? The margin's important. What is the cost of goods sold? What is the gross profit? What is the profit margin? And am I seeing it? I at least ask for 3 months, right? Am I seeing a change, hopefully positive change in the profit margin a month over a month, especially for SaaS companies? In the beginning, they're developing the product, and it's the cost, operating expenses are really, really high. But the profit and the profit margin kicks in, and the software you develop and you sell it many times, the profit margin continues to increase. So general profit margin, general expenses. So general expenses are things like salaries, rent, equipment, the office, anything office related, like supplies or whatever. A lot of them don't even make sense, especially we are virtual right now. But I know companies there are, they have decided, like, third month of COVID, oh, this is working for us. We don't actually need to have a physical space. We can be everywhere in the world and still operate. So they close their release. So I want to really see what's happening in the general expenses. Also want to see, is CEO paying himself a reasonable salary? If not, sooner or later, he is going to say this is not worth it, right? And also at the same time, he's not paying himself $300,000 a year when the startup is in such an early stage, right? So I really want to look at that operating income, right? So what are some of the things, where is the income coming from? A lot of times it's just not the product, it's not just a platform, it's also licensing, it's partnership, it's affiliation. So I want to look at that. How much interest they're paying on loans, especially if they have a convertible note out, and if 40% of their company is running on a convertible note or a bank loan, you want to make sure that that is not such overwhelming. Do they keep taxes on side for the profit? Because I also know entrepreneurs, they put 100% of their profit into their business, which is a great thing to do. But at the end of the year, you got to pay taxes, right? So you want to make sure that they're also allocating money for the taxes, because when the time comes, like, oh shit, we don't have any money, what do? Let's, scramble and, maximize, and I'll go and raise some money. So you want to really make sure that the founders are thinking through in making sure that these are the important things that they need to be accounting for. The depreciation and amortization, what do they look like? Do they have heavy equipment, especially in food and beverage industry? If they are their own manufacturer and packer, like they don't have co-man or co-packer, that they need to have a lot of equipment. So how are they, managing that? Most of the food and beverage companies in early stage, they have a co-packer or co-manufacturer. So they only have an expense part of it, but not necessarily equipment depreciation part of it. But I went to see Impossible Burgers factory in New Jersey, like after, when was that? That was like 2016. So it was just becoming a brand name. And they decided that the New Jersey, because they have such amazing agricultural tax benefit, to have this factory there. So I walked in thinking, oh, this is all Impossible Burgers, but they were actually part of a bigger co-manufacturer who started this for them, but they grew so much that they literally took over half the facility, but they were they were paying rent. They did not have all this equipment that they needed to worry about. I'm sure now they are so big and they have all this equipment, and they're no longer relying on co-packer or co-manufacturer. Any questions here? So this is an example of income statement, so like historical period and a forecast. You always look at the past, how they spent their money, and you look at the future, how they're planning to, spend their money. Cash flow.
Laura, I'm sorry, is Laura on this call?
No, I
she-
think she
she's gone.
said, yeah.
So it's so interesting because like if you use QuickBooks, some of those things aren't that easy just to come up with.
They
know?
are or they are not?
They're not, like cost of goods sold.
Oh, who is talking?
I'm sorry, it's Jennifer.
Oh,
For SaaS at least, because I guess you would just say that's your engineering. It's funny because there's like operational expenses and development expenses and certain things. I was always kind of curious how people calculated COGS. I guess it's a question for another day, but
let me see if I can have one of my companies, my investment companies share their income statement, who are SaaS company. Sounds good.
okay, thank you.
Welcome. How is everyone doing? When I don't see you guys, it's like, okay, I'm hoping everybody's getting value out of it. Okay. So I think silence means yes, we're doing good. Cash flow. So it shows actual time when cash is received for booked revenues and paid for expenses, right? So cash flow means starting cash, incoming cash, outgoing cash, ending cash. So you get to know a lot about not only the company, but the founders. Are they pretty scrappy? They're able to achieve a lot from their, or how are they, or are they literally, going out and saying, okay, we need a $10,000 team building this week because we made $10,000, right? So this is a cash flow example again. This is year 1, year 2, year 3, but then you can dig deep into it by month as well. Obviously, in the early stage companies, you may not have this, and it's okay that they don't have it. But what I would like to know is, have you thought about how you're going to, keep a pulse on your cash flow? And if the founder answer is yes, we have, and they said, okay, we don't have anything in all this, but these are the ways we think that the money, we're going to get the revenue, these are going to cost that we are estimating, et cetera, et cetera. If the founder says no, what's that? So, we go through a little bit of, Q&A session, and I share this, saying this is something that you should definitely get in touch with whoever is helping you with financing and financial and accounting, set this format up. And as you go through, and, you can do this in a year-by-year basis, but also make sure that you have the same element month by month. So you're keeping an eye on, how much money you have, how much money you need, etc. I always also ask a question when the founder is fundraising: how much money do you have in the bank? And that's a very uncomfortable question for many people to ask, including me. But I ask that question because I want to know that they should know the number, even if it's 0. They say, we don't have any money, we have 1 week worth of operating expenses left, or we have 332,700, not obviously the whole exact, but say we have about $300,000. That means that they are on top of what's happening, because without money, nothing matters. Doesn't matter if you're a female founder, doesn't matter if you're an underestimated founder, doesn't matter how great your product is, doesn't matter how much your customers love you. If you don't have a good pulse on your cash flow, it could be very dangerous.
Jags, doesn't that also, wouldn't that speak to how much they need to raise as kind of their monthly burn, as you said, whether it's 12 to 18 months?
Yeah.
If they create the basic cash flow, then they should be able to add month to month and see how much they actually need, which is obviously helpful to an investor, but helpful to the founder as well. I mean,
Yeah, absolutely, Carol. Yeah, that's right on, right? The cash flow is not just about how you're doing now, but how do you plan to use the money that I'm going to give you? What are you going to do with that, right? For the next raise. And also there's another way to calculate the valuation, right? So we talked about the 20%, like every, how much money do you need to raise, right? I get that question asked from the founders all the time. How much money should I raise? I said, okay, let's look at your, like you said, Carol, your burn rate. And let's look at the milestones that you're trying to achieve until your next raise. So let's go in the future, 18 months from now, what kind of revenue do you wish to have, right? And they say, about, let's say $1 million revenue. And they're right now at $100,000 revenue, right? ARR. So $1 million revenue. Okay, great. And in order to get to the $1 million revenue, what do you need? Do you need specific talent, people, hiring? How much are you going to need for hiring? Do you need to spend on marketing budget? What does that budget look like? So we come up with a number, right? Let's say that he said that, okay, I'm at $100,000 right now. I'm spending about, my monthly burn rate is about $10,000, and I'm bringing in 100,000 ARR. In order for me to get $1 million ARR in 18 months, I need to have my monthly burn rate go up to $50,000. Okay, $50,000. So $50,000 times 18 months. So that's about, I don't know, about $750,000. I think I'm assuming I don't have my calculator with me. But let's say, 18 months, $750,000. Okay, so $750,000 you need in order to get $1 million ARR, right? Because there's a lot of things that needs to be in place. In order to raise $750,000, if you calculate that to be the 20% of your company's valuation, then your company is worth about $3.5 million or something like that. And plus, obviously, that's a very just dry calculation. Plus, your revenue, that's another thing that, okay, you grew from 100K to $1 million. And with the same set of people, can you grow from $1 million to $5 million? Or how much more money do you need? So you take all this stuff and you come up with a valuation. Experienced founder get a higher valuation. Amazing advisory and customer relationship get a little bit higher valuation. You can also say that in order for me to get to $1 million revenue, if I spend $750,000, I can also increase my revenue to maybe $1.5 million, right? So you take all that in account, and then you come up with a valuation that you can then present to your lead investor and say, this is what I have in mind, that my company is worth this much, and because of X, Y, and Z. And the lead investor will take that data and say, okay, if you have a lead investor, right? Say, yes, good, bad, this is how much I can, this makes sense, this doesn't make sense. We can go a little bit higher, we can go a little bit lower, but at least there's a stake in the ground to start having this conversation. If you don't have any lead investor, you still want to make sure that whoever you come across, whoever you're fundraising with, you're able to explain that this is why we are raising this much money, because we want to get to this $1 million revenue. And if we get to that $1 million revenue, we believe the valuation of our company for the next raise will be $10 million, something like that. And remember, the multiplication I gave you for SaaS company is usually about 10x, 8 to 10x. For food and beverage company that I have experience with is between 4 and 7x, and there's everybody in between. And also one-time purchase. So for example, if I have Peloton, right? Peloton, I'm not going to buy Peloton every month. So it's a one-time purchase. So they get even a lower multiple. But if I have, Birchbox subscription, right? And if I love it, it's every month after month. This is repeated. So you get a little bit more multiplication for your valuation. So there are a lot of different ways of massaging it. But at the end of the day, you as an investor want to look at the cash flow example and figure this out, that this is where you are. And if I invest right now and you were to raise money 18 months down the road for Series A, I want to know where are you trying to get to, right? And if they, and listen and, do your own calculation, talk to other people who know that, sector or industry, and say, is this reasonable, right? Is this something they are at this point, they want to go to this point? Is this something that, you have experience with, to see how much confidence do you have that these people, knowing what you know, can go from point A to point B? Because you really want to invest in right now, but with the, that's how I invest, with the future in mind. And the future is not 2-3 rounds out. For me, it's one round out. It's one step at a time. I hope that made sense. Balance sheet. So balance sheet is all about what are your assets, what are your liabilities, and your shareholders. Who are your shareholders? And what do they bring? So assets are like, how much cash do you have? How much inventory do you have? Do you own any real estate? Do you own equipment? How much account receivables do you have that have not, that are still in the pipeline? And liabilities, exact opposite, expenses to be paid now or eventually, and that includes taxes. People, don't think about taxes, and it really, really gets them really in a tough spot sometimes, especially when their revenue is really high and able to. So obviously, a good lawyer and a good accountant, you should spend. They should be spending the money in that, not to go the cheap way. I totally believe in that. Shareholders, who are the shareholders of the company? So shareholders in this case are obviously the investors, but also partners, suppliers, licensing partners, who are the people who are contributing to your, company's earnings. So this is a balance sheet example. It's just pretty straightforward. And if you look at the assets, current assets, total assets, liabilities, short-term, long-term debt, and the shareholders' equity, equity capital, what was 70%, or and then retained earned 70,000, retained earning, and what is this shareholders' equity part of it? I always get confused here, so I would not say that I know how. Sometimes I've seen the shareholders' equity as percentage. Sometimes I've seen it as a percent, as a dollar amount. So what are some of the common mistakes, right, that from a founder's perspective, that we should be aware of, right? And as we talk to them, we want to make sure that they are really understanding that the investors look at the companies differently than the founders look at the company. So even when you're looking at your ARPU or EBITDA margins, for early stage investors like myself, I don't pay that much attention to the EBITDA or ARPU margins. ARPU margins I do, but not EBITDA that much. But doesn't mean that you should not have it calculated, because some investor might be interested in that. So you should always have this information available. So high revenue drivers, right? So let's go from the left side. High revenue drivers, conversion rates, churn rates. So what I mean here is how much money are you spending converting your customers and what is your churn rate, especially for a high ticket items. So if you are selling a spaceship, right? These matter very less because, you know, there's only 1 or 2 places in the world I can go buy a spaceship, perhaps. But if you are buying, that's a high ticket item. But if I'm buying something that, you know, like Birchbox, you know, how many customers are being converted and what's the churn rate? So here, I'll give you an example of Birchbox. You know, I've known about Birchbox for a while, but I gifted it to my daughters, but I never used it myself. So I was just on the, you know, I was just surfing the web and I saw this Birchbox, and you get this Amika, the hair curler free if you sign up for 1 year. I'm like, oh, I always wanted to try Amika, but it's about $150 and it's going to cost me $150 to sign up for the Birchbox. So I converted right away. I got my free Amika and I'm enjoying the Birchbox that comes every month. Am I going to renew it? No. So you really want to pay attention to not only how many customers you're converting, but also what your churn rate is. A lot of the times founders only care about the conversion rate and they don't understand the leakage or the churn rate. So you really want to ask those questions. If you have salaries and marketing and infrastructure as a very, very low expense, I would wonder. So if you have a team of 30 people, right now I've invested in this company called Eva.guru. They are an Amazon sellers platform. They have their entire team in Turkey. And you know, he's an underestimated founder from Turkey. Their entire team in Turkey, and he and his co-founder do not take salary. They they take maybe $1,000 a month. And I looked at their team, 30 people, and I know him really well. So, and I said, 30 people and your churn is, your expenses, monthly expenses are 15,000. How is that even possible? I didn't know that he had a team in Turkey. So then he said, oh, that's because we have a team in Turkey and this is what they do. So I'm like, okay, I invested a substantial amount of money in this company. So I'm like, okay, I want to see your payroll. I want to see if, and then I want to talk to a couple of people in Turkey to see if that is something. Then and happily he was able to do this. So I wondered, I'm like, there's no way you can be in the United States and have $15,000 churn with 30 people, right? So that's one, I look at that expense and underestimating time. It always takes longer than expected to generate revenue. So if you say that, I need 12 to 18 months of runway, I always say add, is that your conservative estimate and what could go wrong? Right? What is one thing that could really throw this off the track? And they're like, oh no, nothing. I'm like, okay, Murphy's Law, something always, if something on the back of your mind that you had to consider that, oh, this could impact my revenue, what would that be? Even if it's not happening right now. So what I'm trying to do there is trying to understand that, is this founder living in a fairy tale village, or is he really close to the ground, understanding that things can happen and they have to have a little bit of buffer to make sure that take care of this. If nothing happens, great. It's more, more money you have in your bank. But do you know what could be your number one risk from going from point A to point B? We talked about ARPU, EBITDA margin, top down versus bottom up, forecasting using your model, right? So you can either do a top down or bottom up. So when I said top down, what I meant was, and when I labeled this as common.
Jags, I'm sorry, it's Jennifer. Can you actually go through the first two things?
The lack of comparables and ARPU?
Like how they relate to what we're talking about now.
Yeah, sure. So the common mistake from an investor perspective is lack of comparables, right? So they look at competition and they believe everything the founder is saying. So the founders sometimes have, in the competition slide, they have, these are the competition, and we take their word for it. Sometimes they say there is, there is actually not really an exact competition, but
Oh, I remember you talked about this. Okay, I'm
yeah.
sorry.
So no, don't. It's all good. So there is always, they're going to put less competition on their slide than there is out there. One is every founder believes that nobody else is doing what they're doing.
Right.
Very, 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 very rarely that's true. Second is they always believe that, oh, it's even though if they may be doing the same exact thing, we are much better, right? So dig deep into the competition slide and do your own research. And ARPU is the average revenue per unit, right? So is the measure of the revenue generated per unit or per user? So Birchbox ARPU is probably really high because they don't even make these cosmetics, right? These are the samples that are given to them to distribute to their community. So the ARPU is really high. But if I go with a company that is, like Impossible Burger, we were talking about that before, right? If they were to have their own facility, whatever, the ARPU is, it's going to reduce because they have a lot of, and EBITDA is something that, I need to.
Right, earnings before taxes and
Yeah.
depreciation.
Yeah. And a lot of times, the founders or the investors don't look at that, but it's actually relatively important post Series A, I would say, but pre-Series A, it's not that important. It just provides investors a snapshot of short-term operational efficiency, right? So how efficient are they with their cash?
Okay.
Top down versus bottom up, forecasting using your model. So we talked about the top down is this is how much I'm raising. Therefore, it's 20%. Therefore, this is my, this is a valuation, right? And investors are sometimes really, really stickler to this. So for example, the example that I gave you before, it was $3.5 million valuation. But you then have to really make sure that are you taking in account the other important parts of the equation. For example, founder market fit, product market fit. Is the pain, the problem that they're trying to solve, really something that the customers are gonna say, yes, we can see a lot of value, right? So come up with that, whatever works for you. Do some research on how others are evaluating. There is no magic wand for valuation. That's what I want to tell you here. Or you could do bottom up. What is bottom up? You look at the revenue and you say, okay, they are in this industry. They are at $100,000 revenue. They want to go to $1 million revenue. I believe that everything, they have a path to going there. So if it's $1 million and if it's a SaaS company, I'm going to multiply that the high level 10x, low level 7x. So $7 million to $10 million, right? And that's what I feel comfortable with. So if I'm looking at a convertible note, and if the cap is $15 million, I'm going to say, no, I want the cap to be $10 million or $7 million. So that's what I meant by, excuse me for 1 second.
Thank you so much.
Sorry, go ahead.
I was just saying thank you. I realized you had touched on some of them, but it was nice to just hear it in this context.
Oh yeah, sure. You're welcome. But so there is no magic wand, or there is no magic formula when it comes to evaluation. You will see from totally ridiculous to really low to really high, but then go back to your thesis and think, what do I feel comfortable? What do I know about this problem? What do I know about what we are trying to solve here? And always founders say, oh, it's going to, take me 2 months. I already have lined up all the investors and they're just waiting for me to come up with a term sheet so I can go ahead and raise. No matter what they say, always think that it's going to take them 6 to 9 months. If they get done early, great. but a lot, and ask them this question that, okay, let's say that you don't get all the funding in 2 months. How much of runway do you have left? Maybe they're saying 2 months because that's all they have in the bank. So you want to really understand that even if it doesn't take 2 months, do they have enough revenue coming in, or enough a bridge round that, investor that's going to give them the money until they raise the financing? So it takes them about 6 to 9 months to raise secure financing, no matter what the founders say. And these are just, I don't know why I put this here, but the revenue is something that is, I know why I put this here, I don't know why I put this here. I put this here because the revenue is calculated in so many different ways. So what I do is I look at the company that I'm trying to invest in, and what is the number one metric for them, for the product or platform or service that they are creating, which I'm interested in investing. So I look at their conversion rate, right? Definitely. I look at their pricing, average order per value, how much value do I get on average per order. I don't look at their metrics that much. Some of the other people do in my network. Gross versus net, very important, right? What's the profit margin? What's the revenue model? Is it recurring, or is it once a month, once a year, just once in a lifetime? What is the MRR versus ARR, right? How do they calculate MRR, and how do they calculate ARR? So a lot of times what MRR is, like monthly recurring revenue. So how much money I make in a 1 month, and I want to see month over month, like how much are you making, from last month to this month, and what are you forecasting for the next month? And similarly, I would like to see your annual revenue, recurring revenue. And annual recurring revenue actually is tricky in a way because it changes, right? So let's say in January, I made $10,000 as a, for my product. My ARR at that point is $120,000, right? It goes from January, the month I'm in, for 12 months out. In February, I made $50,000. So now my ARR is going to change because I have a now new baseline, 50,000 times 12, so 600,000. But if you see a huge difference in those, you want to always wonder. But ARR sometimes is calculated simply by where I am times 12 months, and it changes every month. Or they, ask the question, how did you calculate your ARR? And just be quiet and let them explain. Repeat value. Is the customer going to buy this again and again? What's the churn rate, right? Are they only focusing on coming in, or are they also looking at leakage, and how are they paying attention to solving the churn rate, right? And lifetime value. Lifetime value is like with enterprise SaaS platform, and it's about 3 years. With because enterprise don't change the vendors that often if they like. That's why it takes them a long time to get in contract, but once they are in contract, it's 2 to 3 years. Versus a D2C company, it might be much, much lower. So you really want to make sure that your conversion rate and your LTV ratio is over 1. And we'll go through that formula. Expenses, variable versus fixed, right? What are recurring expenses, which are fixed from month to month, and what are variable expenses that, so for example, domain hosting or the team salary, etc. Variable could be the marketing budget. What's your gross profit margin, your CAC, right? Your CAC is your customer acquisition cost. So you really want to make sure that you understand the customer acquisition cost. Sorry, I meant to say CAC over LTV to be over 1, not conversion rate over LTV. My apologies. Cost to maintain a customer, customer success. Do you have it? Like, is your cost to have somebody serving the customer higher than, but you have a very low leakage? Then you want to balance that. And I'm throwing a lot at you. And because I want to make sure that, you know, I'm planting seeds in your mind with all this stuff. So when you do look at a company, you may be able to say, hey, I want to go and see if what kind of revenue model or what's their MRR versus ARR. Let me go to Jack's slides and see, you know, if I need to review, or anywhere else, obviously.
I have another question, sorry.
Sure.
I'm sorry, I'm asking a lot of questions today.
Please do.
For early stage founder, what is like 1 or 2 examples of how they can even answer their cost to maintain a customer or cost to acquire a customer? Like, is there a simple way for them to answer that?
I wouldn't ask them to answer simply. I would ask them, they should know this no matter what in early stage. How are they acquiring customer? And if they say it's all organic word of mouth, it's 0.
Right.
Right? Which is great. And how long do the customers stay with you? Oh, they stay forever. No, tell me how much, like, when do they buy the product again, right? So then you're and how long do they stay with you? So they should know this. And if they don't know this, it's okay. But you should, as an investor, always educate them that these are important metrics for investors, specifically for your business. So would you mind taking some time and getting back to me about that? Because I really am interested in understanding your CAC and LTV are.
And what would they do? They would say, like, this is my salesperson, this is what I'm spending on marketing, this is whatever divided by how many customers I have?
That's our next.
Okay, so, oh, look at that. Okay, thank you.
Okay, so lifetime value, right? So let's go to CAC because we're talking about CAC, right? So customer acquisition is cost to acquire customer, and N is a number of customers acquired using the cost. So for example, Starbucks spends $2,000 to acquire 45 customers. So their CAC is, sorry, it should be 2,000 divided by 45. So it's customer acquisition cost per customer. So whatever that is, I don't know why there's something wrong in the formula. 2,000 divided by 45 is the actual, is their CAC. So what your question was that, what do I calculate as part of $2,000, right? Like, do I say it's a salesperson salary, it's marketing budget, whatever? That, depending on the product, like for Starbucks, it's probably advertisement, right? The marketing budget. So you don't necessarily calculate the salary of a marketing person, but you look at the marketing budget, the raw dollars that you're spending in advertising. And from that, that's why you get asked this question, how did you hear about us, right? Because they really want to link their marketing dollars to how you came to buy from them. And if they only have one campaign running, and from that campaign, they have 45 customers, then you know that it was the amount of money they spent on that one campaign divided by 45 customers. So I'll give you in the real estate example, right? Real estate agents, they spend a lot of money on, the postcards, right? We all get them, right? They get the postcards. And every time I get a postcard and I call them, right? And they say, okay, how did you hear about us, right? So this is how I heard about you. So I know that this is how much I spent and this many people called in. Now, how many of those people are actually going to buy the house from me? Is that the metrics I should be paying attention to? Maybe out of 45 customers, one customer bought a house for me. So but in that business, that's not the end game. The end game is to keep having customers connect with you, even though they're not ready to buy, because eventually either they will buy or they will refer somebody to you, or majority of them won't even call you. but so it's a drip campaign, right? So you really want to understand that what makes sense for your business to come up with this number, which is said, this is how much money I spent you acquiring one customer. And the LTV value is lifetime value. So the average customer expenditure per week over an average customer lifespan. So if you go back to Starbucks, right? So a customer buys coffee from Starbucks 3 times a week for 20 years. So 52 weeks times 12 times, 52 weeks times every week they spend $12, $4 a cup for 20 years. So that is their lifetime value. You should know this as a founder should know this, because it's important to have that metric to understand what are your customers doing, how are they buying, are they repeat customers. In the beginning, they will not have this, but they should know what this is and how they're going to get there calculating this. These are very, very important metrics. Oh, wow, look at that, 10:45. So that's what was today. Have I lost you all?
No.
Oh, well, I'm glad you're still with me and smiling. So,
That was fun today.
yeah, thank you. Thank you.
My husband just invested in a startup and I keep asking him, what is the cap on it? And he can't find it.
Who is that? Your husband?
Yeah. I
Well-
know. I've just been texting with him. I'm like, what is the dollar amount that they put on it? And he said, no, it's a pro rata discounted equity share. I don't know to write it down, but I'm like, does it say a dollar amount for the next round? And he can't find it anywhere.
Well, so why don't you do this? Why don't you ask your husband to get in touch with the founder and say, hey, do you mind resending me the term sheet I signed? And if you want to, get together with me, I can review it with you and see if there are any flags. Yeah,
I
sure.
learned so much in 4 days. I can't believe it. Thank you.
Yeah, impress him. It's like, okay, you're not doing investment from now on. I'm in charge. All right, guys, I am so happy that we've come to this and excited to see you all at the pitch session. I can stay back if you guys have any question, or we can say bye and meet in the pitch session. It's up to you.
Do we have the link for that or is it in Mighty Networks?
Kate?
It's in Mighty Networks as
Okay.
an event.
Great. I can find it.
Yes. Okay, cool. Okay, awesome. Bye, everybody. Someone's playing some delightful music, by the way.
Oh, sorry, my son.
No.
No, it's great.
All right,
right.
we'll see you ladies
Bye,
soon.
everybody.
And then 2 p.m. Tomorrow is office hours at 3 p.m. Eastern.
Yeah, 12 to 1
Okay.
tomorrow. Yep.
Okay.
12 to
All
1, sorry, PST, since I'm in
Yeah.
California. Yeah.
Okay.
Come
See
with
you
all
then.
questions, come with